Welcome to the Pro Ticker Deep Dive.
It's great to be here.
It is mid-February 2026. To be specific, we're digging into the world right after those big February 18th data releases dropped. And I have to say, looking at the screens this morning, the cognitive dissonance is just getting really loud.
Deafening is the word I'd use. Yeah.
I mean, if you just rewind the tape, 8 weeks? To December of 2025, the narrative was, well, it was basically unanimous. Everyone was doom scrolling.
Oh, absolutely. The yield curve was inverted. Everyone was talking recession. Consumer sentiment was just in the tank.
Right. And the consensus forecast was pretty much brace for impact. And now you fast forward to today, and the phrase on everyone's lips is Rust Belt resurgence.
Right.
The speed of that shift, that's what's bothering me. Is this a real, genuine economic pivot, or are we just looking at some kind of, a data anomaly?
That is the question of the quarter, isn't it?
Yeah.
Pivot might honestly be too soft a word. It feels more like a phase change in physics,
Liquid to gas.
Exactly. We went from liquid to gas in about 30 days. You've got factories in the Midwest, in Ohio, in Indiana, reporting activity levels that, we haven't seen since that post-COVID boom back in 2022. The data is undeniably popping off the charts.
But, and this is the huge but we have to get into today, the context around this boom is just so incredibly weird.
Weird is the technical term I'm using in my own notes, actually. I can't think of a better word.
So we have a manufacturing boom, sure, but then you have this geopolitical backdrop that feels like it was written by a Tom Clancy ghostwriter who was, on a serious deadline.
Right.
We almost crashed the entire global trade order in January over Gordon buying an island.
Okay.
And then you look at the labor numbers, and it's completely decoupled. The factories are humming, but the parking lots, they're not getting any fuller.
That's it. The Greenland gambit and this jobless growth phenomenon, on the surface, they seem totally unrelated, but they are actually the two pistons driving this entire engine.
Okay, so that's our mission today. We have to connect those dots. We're not just going to read the PMI headline number. I really want to understand why a threat to buy Greenland somehow resulted in a factory boom in Lafayette, Indiana, and why Wall Street is cheering for an economy that might be leaving the American worker behind.
It's a really complex feedback loop. You've got geopolitics driving fear. That fear then drives corporate hoarding and technology. Well, technology is driving the execution of it all.
Okay, let's start with the hard numbers then. The headline that really woke everyone up.
The Purchasing Managers Index, the PMI.
Now, most of our listeners track this, but just for clarity's sake, this is a diffusion index, right? It's a survey. They go out to supply chain managers, and they ask a really simple question. Is activity higher, lower, or the same as last month?
Correct. And that magic number is 50. Anything above 50 means expansion. Anything below means contraction. And for the entire year of 2025, 12 straight months, that number was it was dead water.
Stuck in the high 40s.
Exactly. It was sitting around the 48s. The manufacturing sector wasn't just paused, it was actively shrinking. So the consensus expectation from the street for January 2026 was just more of the same. I think the number was a gloomy 48.5.
Which is what makes the actual print on February 6th so completely shocking.
It didn't just inch over the line. It wasn't 50.1. It hit 52.6.
So that's a 4-point swing against expectations. In the world of economic statistics, that is a massive standard deviation event. That's not just noise.
No, that is a signal, a huge one. It's the highest reading since 2022. But, and this is important, you have to look under the hood of the number.
Right, because a headline PMI can be distorted.
It can, by things like supplier delivery times. If trucks are slow because of a snowstorm, the PMI actually goes up. But that's not good growth. That's not what happened here. This move was driven by the new orders subindex.
I saw that chart. It honestly looked like a crypto pump and dump. It was just a vertical line.
It jumped 9.7 points to hit 57.1. And, to put that in perspective for everyone, a 2 or 3 point move in that index is considered significant volatility. A nearly 10-point jump suggests a flood, a tidal wave of demand entering the system all at once.
So it means that on January 2nd, the fuel lines at factories in Ohio and Michigan started ringing off the hook, and they didn't stop.
They did not stop. That's the picture it paints.
Okay, but let's play devil's advocate here for a second. Is this organic demand? Are consumers suddenly running out and buying 10% more washing machines and cars? Or is this just companies restocking their empty warehouses? Because if it's just restocking, this is a sugar high, it won't last.
And that is the critical distinction we need to make. If you look at the industrial production numbers, which the Fed released alongside the PMI, total industrial production is up 2.3% year over year.
Okay.
And month over month, manufacturing output specifically rose 0.6%. That implies that the stuff is actually being made and shipped, not just ordered to sit in a warehouse.
But again, I have to ask, what is being made? Because if I look at the retail sales data, the consumer looks a little wobbly. They don't look like they're on a spending spree.
You've nailed it. This is not a broad-based consumer boom. This is not people buying blenders and couches and, home goods. The charge is highly, highly concentrated.
And what?
It's being led by heavy industry and high tech. So you're looking at transportation equipment, that's aerospace, that's automotive. Computer and electronic products are surging. And machinery, that's a big one, is seeing a massive lift.
And machinery is always a leading indicator for CapEx, for capital expenditures. If you're buying a machine, it means you're planning to build something bigger later.
Precisely. Just look at Caterpillar. The stock jumped 6% on this news, but the story isn't just we sold more bulldozers. They recently announced a $725 million investment in their facility in Lafayette, Indiana.
Okay.
Now, 20 years ago, if Caterpillar announced a big investment in Indiana, that would mean they expect a housing boom.
Right, more excavators to dig foundations for new subdivisions. Simple.
Simple, but that is not the play here. A huge part of that new investment is specifically for building large-scale backup power generation engines for AI data centers.
So even the quintessential Rust Belt bulldozer company is now an AI derivative play.
In 2026, you have to understand, everything is an AI derivative play. It all comes back to it. Data centers need 100% uptime. You can't have ChatGPT go down because a thunderstorm hit Indiana.
Of course.
So you need massive diesel or natural gas backup generators. Caterpillar is pivoting its legacy industrial capacity to support this huge digital build-out.
That connects the dots to John Deere, too, then. I saw they're opening a new excavator factory in North Carolina and a distribution center in Indiana. But their press release was interesting. They explicitly mentioned supply chain resilience.
Resilience. That is the corporate buzzword of the year. Of the decade, maybe?
Seems like it.
They want to bypass overseas supply chains completely. They got burned badly in the 2020s, and now they are absolutely terrified of what happened in January with those trade threats. Yeah. They want the metal to be bent and welded within driving distance of the final customer. No more waiting for a container ship.
Which brings us to the foreign capital, because it's not just U.S. companies onshoring their production.
No. And this is arguably the bigger, more surprising story. Following that new trade pact that we'll get into, we saw a massive announcement from Japan, $36 billion.
That is a staggering number for a single foreign direct investment, an FDI announcement.
It is, and just look at where it's going. Ohio, Texas, Georgia. There's a $33 billion natural gas power plant in Portsmouth, Ohio. Again, power.
It's all about power.
They aren't building a toy factory. They're building the energy grid that's required to run the AI clusters of tomorrow.
I saw this one, an industrial diamond plant in Georgia. That sounds a little strange.
That one caught my eye, too. It sounds like jewelry, I know, but it's actually all about semiconductors. Synthetic diamonds are critical for heat sinks in advanced electronics.
Ah, okay.
The highest-end chips get incredibly hot, and diamond is one of the best thermal conductors on Earth. It pulls the heat away so the chip doesn't fry itself.
So this manufacturing boom is really a strategic infrastructure boom. We're building the shell, the power, the cooling, the specialized components, the chips for the next economy.
That's exactly right, which makes the whole boom less insensitive to whether the average consumer is buying a new blender and much more sensitive to the corporate balance sheets of Microsoft and Google and Amazon.
Okay, let's pivot. Because we've established that the factories are running hot. But you mentioned earlier that this is partially being driven by fear. And the source of that fear was the absolute chaos we all watched unfold in January.
The Greenland Gambit. It still sounds ridiculous saying it.
It does. It sounds completely ridiculous when you say it out loud. The U.S. wants to buy Greenland. It became a meme on the internet instantly. But for the markets, this wasn't funny at all. It was a heart attack.
I think it helps to frame this using a concept I saw from the Atlantic Council. They described the current U.S. trade policy as a kind of medieval diptych.
A diptych, like two paintings on a hinge.
Exactly. Two panels hinged together. On the left panel, you have the very public face of U.S. policy. Volatility, threats, erratic demands, tariffs being used not as, economic adjusters, but as blunt force trauma weapons. That was the Greenland crisis.
Okay.
But on the right panel, sort of obscured from the headlines, you have the boring, sensible, constructive deal-making that's happening behind the scenes.
The problem is we spent 3 straight weeks staring directly at that chaotic left panel, Walk us through how that escalated so quickly.
Well, it started with a renewed, and this time highly specific, demand from the White House to acquire sovereignty over Greenland. Now, the strategic rationale, to be fair, is sound.
Right? Rare earth minerals, Arctic shipping lanes, security.
All of it. Rare earth minerals and Arctic security dominance as the ice caps continue to melt. It makes sense on paper.
But legally, it's a complete non-starter. Denmark was never going to sell a semi-autonomous territory and its entire population like it's a used car.
Of course not. So Denmark said no. The EU immediately backed them up. And in normal administration and normal time, that would be the end of the diplomatic cable. Conversation over.
But not this time.
Not this time. On January 17th, the White House weaponized that rejection. They threatened a 10% Arctic security tariff.
And the key is it wasn't just on Denmark.
No, that's what was so shocking. They targeted 8 NATO nations: Denmark, Germany, France, the UK, the Netherlands, Norway, Sweden, and Finland.
That is the absolute core of the Western alliance.
It was a profound shock to the system. The threat was, basically, come to the table and negotiate by February 1st, or face 10% tariffs on everything you sell us. And, this was the real kicker, if a permanent deal isn't reached by June 1st, those tariffs automatically ratchet up to 25%.
And markets, they hate uncertainty, but they absolutely despise the idea of a trade war between allies.
So on Tuesday, January 20th, markets opened after the holiday weekend, and the S&P 500 just flushed. It dropped 2.1%. It was the worst trading session in months.
Because suddenly, every investor realized the entire U.S. consumer market was being held hostage against our closest NATO allies. I saw Novo Nordisk, the Danish pharma giant behind Ozempic and Wegovy, their stock dove 9%.
And the German automakers, BMW and Mercedes, they all took a huge beating too.
It really looked like the transatlantic alliance was fracturing right in front of us.
It did. But then, just as suddenly, we flip over to that right panel of the diptych, the quiet behind-the-scenes deal-making. Davos, the World Economic Forum. While all the headlines were screaming about tariffs and trade wars, the U.S. president had a meeting with the NATO Secretary General, Mark Rutte, and they hammered out a framework.
They called it a board of peace, which frankly sounds a bit Orwellian to me, but what does it actually do?
It's a face-saving mechanism, really. The U.S. dropped the demand for actual land ownership, for sovereignty. In exchange, they got guaranteed priority access to mineral rights and, crucially, permission to build security infrastructure on the island.
Including this thing they're calling the Golden Dome.
The Golden Dome, which is a proposed missile defense shield for the entire Arctic region based in Greenland. So just look at the trade-off here. The U.S. threatened to blow up the global economy, and in exchange, they extracted military basing rights and resource dominance over the Arctic.
It really is a protection racket. Nice export economy you have there, Germany. Shame if something were to happen to it.
It's brutal, but from their perspective, it's incredibly effective. It signals the definitive end of the globalization era, where trade was all about finding the cheapest, most efficient solution. We are now firmly in the sovereignty era. Trade is about leverage, period.
But here's the lingering problem, the thing that hasn't gone away, the June cliff.
Correct. The 10% tariff was suspended. It wasn't canceled. The threat of a 25% hike on June 1st is technically still live if the specific legal details of this Board of Peace aren't finalized to their satisfaction.
So if I'm the CEO of a German auto parts company or a supply chain manager in Detroit who relies on those German parts, I don't feel safe at all.
You feel terrified. You look at your calendar, you see that date, June 1st, circled in red, and you pick up the phone and you say, ship everything you have now. I don't care where we put it, just get it on a boat.
And that brings us full circle right back to our manufacturing boom. This is the tariff pull forward.
This is the hidden linkage that validates all my skepticism about those incredible PMI numbers, that 9.7-point jump in new orders. A significant portion of that is likely just defensive posturing.
It's panic buying that's masquerading as organic growth.
Pre-buying is the polite term the industry is using, and we have direct evidence of this. The Equipment Leasing and Finance Association, they conduct monthly surveys of the major captive finance companies. The lending arms of manufacturers like Caterpillar or Volvo.
And what are they hearing from their customers?
Well, one respondent in the latest survey explicitly stated, and I'm quoting here, "We suspect a tariff pre-buy effect is occurring as customers accelerate purchasing decisions ahead of potential cost increases." It's right there in black and white.
Okay, so walk me through the logic just to make it concrete. Let's say I run a construction firm. I know I'm going to need 10 new excavators for a big project that starts in August.
Okay, so normally you might place that order in May or June, right? Give them a couple of months to deliver. But you're watching the news. You see these headlines. You know that on June 1st, the cost of that German-made hydraulic system or the imported steel chassis in that excavator could jump by 25%.
And on $1 million order, that's a $250,000 hit to my margin. I can't absorb that.
Exactly. So what do? You order them in January.
I order them in January. I sign the lease agreement. I take delivery as soon as they're ready, and I'll pay to store them in a lot for 3 months if I have to.
Because it's far cheaper to pay for 3 months of storage than it is to pay a 25% tariff.
This has to be distorting the data significantly.
It's a massive distortion. It pulls demand from the third and fourth quarters of the year and crams it all into the first quarter. It creates this beautiful hockey stick-shaped chart that looks amazing right now in February, but the bill for that, it comes due later.
You create an air pocket.
That's the perfect term for it. An air pocket. If everyone who was planning to buy a tractor this year buys it in January, who is left to buy a tractor in July?
Nobody.
Nobody. The order book could go from overflowing to completely empty almost overnight once that June deadline passes. And that's true whether the tariffs actually hit or not. The buying has already happened.
So we are essentially stealing growth from the future to make the present look better.
We're borrowing it at a very high interest rate. And if the underlying economy, the real consumer economy, isn't strong enough to fill that gap the second half of the year, we could see a very sharp slowdown, maybe even recession, immediately following this boom.
This June cliff is the sword of Damocles hanging over the entire Rust Belt right now. But there's another structural issue here that makes this particular boom feel different. Historically, when factories ran this hot, when new orders were up almost 10%, you saw help-wanted signs on every lawn. You saw wage inflation for blue-collar workers.
And that is the piece of the puzzle that is so conspicuously missing this time. We are seeing a profound, and I think permanent, disconnect between output and employment. This is the great paradox of jobless growth.
Let's look at the numbers. The PMI employment subindex, where did that land?
It's sitting at 48.1.
Yep.
And remember, anything below 50 is contraction. So at the exact same moment that the new orders index is screaming higher at 57.1, the employment gauge is telling us that factories are actually shedding workers, or at best, not hiring a single new soul.
And the Bureau of Labor Statistics data, the official jobs report, it backed this up. Manufacturing added a net total of, 5,000 jobs in January?
Which, in an economy of 160 million workers, is a rounding error. It is statistically zero. And if you dig into the sector-by-sector breakdown, it's even starker.
How so?
The chemical sector, which saw a big production boost, actually lost 1,800 jobs. The apparel sector lost another 1,800 jobs. They're making more stuff with fewer people.
So how are they doing it? Are the existing workers just pulling double shifts? Is it all overtime?
Productivity gains from the existing workforce are part of it, sure. But the real driver here is capital expenditure CapEx, specifically in automation and AI.
We talked about Caterpillar building engines for data centers, but this is about the factories themselves essentially becoming data centers.
That's it, exactly. The spending numbers coming out of the tech giants give us a huge clue as to where all the capital in the economy is flowing. It's not flowing into payroll. It's flowing into silicon and steel and concrete.
Give us a sense of the scale of this spending.
It's just astronomical. I mean, it's hard to wrap your head around. Google alone is planning to spend between $175 billion and $185 billion in CapEx in 2026.
Okay, stop there for a second. $185 billion. That is larger than the entire GDP of roughly 130 countries from one company in 1 year.
It represents a doubling of their spend from the previous year. Microsoft is increasing their CapEx by 58%. Amazon is expected to hit $200 billion.
And this money is not just buying software licenses or hiring coders.
No, and that's the big misconception. People hear tech CapEx and they think of software engineers in Silicon Valley. It's not that. It's concrete for the foundations, copper for the wiring, advanced HVAC systems for cooling, and highly advanced manufacturing equipment for the servers themselves. They are building the physical layer of the AI economy from the ground up.
It's like building the world's most expensive, fastest race car, but then you realize you don't actually need a driver anymore. The car drives itself.
That is the perfect analogy. The factories of 2026 are being retrofitted with robotics and AI-driven process controls that allow them to scale their output without scaling their headcount. A chemical plant that used to meet 50 human operators might now run with 10 people monitoring a wall of screens.
This creates a really weird split in the economy, doesn't it? Because if you own NVIDIA stock, or if you're a corporate executive whose bonus is tied to efficiency and margins, this is the best year ever.
This is the classic definition of a K-shaped economy, but it feels like it's on steroids this time. The top arm of the K is shooting straight up. That's corporations, asset holders, the people who are riding this AI wave. Their stock portfolios are up, corporate profits are robust because they aren't being weighed down by rising labor costs.
And the bottom arm of the K, the one going down.
That's the median worker, the person who relies on a wage, not on capital gains from their stock portfolio. And we are seeing real signs of stress there. The Federal Reserve's Beige Book, which is where they gather anecdotal data from their business districts, it noted that retailers are seeing their customers become incredibly price sensitive.
I saw the term soggy used over and over again to describe the housing market.
Soggy is accurate. High interest rates are still keeping a lid on housing activity. But it's more than that. It's this bifurcation of confidence. We can announce a $33 billion power plant deal in Ohio, which is great for the construction firms and the energy companies involved, but the average person living in Portsmouth, Ohio, might not see a single dime of that if the plant is largely automated and run from a remote location.
And if they do see a little more money in their paycheck, it's just getting eaten by inflation. We all thought we had beaten the inflation monster back in 2025, but it feels like it's clawing its way back out of the grave.
It is not dead. It's just sticky. The prices index within that PMI report is still elevated at 59.0. That is dangerously high. It means manufacturers are paying more for all of their inputs: steel, aluminum, energy, copper.
Is that a direct result of the tariff threats?
That is a huge part of it, yes. The moment you threaten tariffs, suppliers start raising their prices to hedge their own risk. Insurance costs are also skyrocketing, partly because of climate risk, partly due to this new geopolitical risk premium.
And surely the AI build-out itself has to be inflationary, right?
Tremendously so. Think about it. When Google, Microsoft, Amazon, and Meta are all competing in the open market for the same finite supply of copper, electrical transformers, and specialized cooling equipment, the price of those commodities goes up for everyone.
So if you're a home builder just trying to buy some copper wire for a new house,
You're now competing against $1 trillion data center project. You are going to lose that bidding war every single time.
So this puts the Federal Reserve in an absolute nightmare scenario. For months, everyone on Wall Street was pricing in aggressive rate cuts for 2026. They wanted the pivot.
And they're very likely going to be very disappointed. The Fed is completely trapped. Just look at the data from their perspective. The economy is hot in terms of manufacturing and industrial production. Inflation is sticky and high at 59.0 on the prices index.
But the labor market is soft.
Exactly. And the Fed has a dual mandate: stable prices and maximum employment. Usually those two things move together. When the economy booms, jobs boom and inflation rises. When the economy tanks, jobs tank and inflation falls. It's a simple relationship.
But now they're completely decoupled.
They are. We have a booming industrial sector, sticky inflation, but a soft employment picture. So if the Fed cuts interest rates aggressively to help the labor market, they risk pouring gasoline on that inflation fire. They could easily send inflation right back to 4 or 5%.
But if they don't cut rates,
Then that soggy housing market and the stressed consumer at the bottom of the pay might actually break. They could tip the economy into recession that way.
so what's the most likely path forward? What's the forecast?
The consensus is now coalescing around a shallow easing path. That's a term JP Morgan and Goldman Sachs are both using in their latest notes. So maybe 2, maybe 3 small cuts in 2026.
That puts the Fed funds rate settling where? Around 3%.
Probably somewhere in the 3% to 3.25% range. And that is not the zero interest rate world of the 2010s. This is a new world where capital has a real cost.
Which means mortgage rates aren't crashing back down to 3% anytime soon.
No, absolutely not. And that just reinforces the K-shapes we're talking about. If you already have capital, you can now earn a safe 5% on it in a money market account. If you need debt to buy a house or a car, you're paying 7%. It structurally widens the wealth gap.
Now, let's zoom out globally for a minute. How does the U.S. look compared to everyone else? Because we talked about Europe being in a panic about these tariffs.
The U.S. is, to put it bluntly, the only game in town right now. Goldman Sachs is forecasting the U.S. to grow at 2.6% in 2026, which is quite strong. And the euro area is forecast for just 1.3%. They're growing at half our speed. Europe is struggling with these deep structural issues: bad demographics, high energy costs. Plus, they are the ones bearing the direct brunt of all this trade uncertainty. The U.S. is essentially importing their capital, like that huge Japanese investment, and exporting our inflation and uncertainty to them.
What about China?
China is a very mixed bag. Their manufacturing is strong, they're exporting a ton of goods, often at deflationary prices just to clear their own domestic glut. But their domestic demand is incredibly weak. Their property sector is still a huge drag on their economy. Their consumers are saving, not spending. So the U.S. really stands alone as the robust demand center of the entire world economy.
I want to do a quick lightning round on a few specific sectors because I know we have listeners who really care about these details. Let's start with semiconductors. We heard about new tariffs there.
Yes, on January 14th, the White House issued a proclamation, a new 25% tariff on advanced computing chips.
Ouch. Does that hurt us as much as it hurts them?
It's very nuanced. It's what you call surgical tariff. It specifically targets the highest-end chips, your NVIDIA H100 types, that are coming from certain jurisdictions. But in this is the crucial part. There are specific exemptions for U.S.-based data centers.
So if I'm Google and I'm building a new data center in Iowa.
You might be exempt from the tariff. It's designed to encourage building the use of the chips here on U.S. soil while penalizing foreign competitors who might want to use those same chips to build their own AI infrastructure. It's a very targeted form of protectionism, all aimed at ensuring U.S. AI dominance.
Okay, critical minerals. We talked about the minerals in Greenland. Are there tariffs on those?
Not yet. The U.S. needs those too badly for batteries in EVs to slap tariffs on them. Instead of tariffs, the strategy they're using is price floors.
Price floors.
The U.S. is trying to set minimum prices for things like lithium and cobalt to protect Western mining companies from being undercut by cheap Chinese supply. That's all about keeping the mines in friendly places like Canada or Australia or potentially Greenland economically viable so we're not dependent on one source.
And finally, utilities. We mentioned them earlier, but that number is just staggering.
Output jumped 7.2% in January alone. Now, part of that was a cold snap across the country. Weather always plays a big role. But the underlying trend is crystal clear. The electrical grid is the new bottleneck of the American economy. You cannot have an AI revolution without a revolution in electricity production. Utilities are effectively a growth sector now, which is something we haven't said in a very, very long time.
It really is a fascinating picture when you put it all together. When you step back and you look at the whole diptych, the chaos on one side and the boom on the other, how do you synthesize all this? What is the real narrative of 2026 so far?
I think the phrase constructive chaos sums it up best. We have undeniable chaos in geopolitics, tariffs, threats, the whole Greenland saga. But out of that chaos, we are seeing a very real construction boom. We're building factories, we're building data centers, we're securing our supply chains for the future.
But the construction itself, it just looks different this time.
It looks totally different. It's being built with robots, not people. It's driven by a need for security, not a search for efficiency. And it's all funded by fear of tariffs, fear of running out of processing chips, fear of geopolitical instability.
The Rust Belt is definitely getting polished up, but it feels like it's being polished with a very different kind of wax than before.
And we just can't forget about that June cliff. We are riding high on this tariff pull-forward wave. If that wave crashes into the shore this summer and the underlying consumer demand isn't there to replace it because the high-paying jobs aren't there, the second half of 2026 could look very, very different from the first.
And that leads me to the one big question I really want to leave our listeners with today. We're seeing this massive, undeniable boom in making things. We're producing a record amount of goods, but we're seeing a stagnation in the number of people needed to make them. We're just not hiring.
Right.
So if that tariff pull forward runs out of steam in June, and those high-paying AI jobs don't really materialize for the average worker, who is going to buy all this stuff that we're suddenly producing?
That is the multi-trillion-dollar question, isn't it? Supply creates its own demand, according to classical economics. But in a highly automated K-shaped world, well, that link might finally be broken.
Something to mull over as you watch the stock market rally to new highs. Thank you for joining us on this deep dive into the weird and the wild economy of 2026.
My pleasure. Stay curious out there.
We'll see you on the next Deep Dive.